Let me introduce myself. My name is Jeremy Loh. I'm one of the co-founders and the managing partner of Genesis Alternative Ventures. This is Meet the Founders Breakout Room 3. And the topic that these tech leaders will be talking about is really about accelerating financial inclusion across Southeast Asia through Fintech. We're going to talk about a little bit about, what are the pros and cons, what are the hidden costs, and, whether when it comes to financial inclusion, right, how does it really work, and if it's truly effective as well. And towards the end of the chat, right, we're going to understand a little bit about how each of these three, tech leaders are accelerating the financial inclusion trend. And as they unfold and grow their business through the COVID session, how are they actually dealing with the uncertainty in terms of the environment? So thank you all for joining this session. This is the most exciting of the three. That's why you're here. And I'm glad that you've decided to join me. To kick us off, I would go around the table and have each of them introduce themselves and the company that he's a part of. So we should start alphabetically so no one feels a little bit left out. Arun first. Arun, over to you.
Fantastic. Thank you so much, Jeremy, and the entire Genesis team for giving me the opportunity. To begin with, background. Well, I started out in investment banking. I made the quality career choice of joining Lehman Brothers back in 2006, a couple of years right before bankruptcy. So started out at Lehman, New York, moved to Hong Kong, then Singapore, transitioned over to Nomura post-bankruptcy, was with Nomura for about a decade after that. So all on the structuring and options trading desk on the capital market side. After over a decade of investment banking, I thought it's time to reclaim my soul from the devil or getting bit by the entrepreneurship bug, I guess. I joined a fintech startup in the wealth management space at a very early stage, headquartered out of Singapore. After about 3 years of that, I met Thomas, who is the founder of Flow, and decided to join the company as the Chief Sales and Strategy Officer for the business. A little bit about us. We are an AI-enabled credit management fintech. That's quite the mouthful, so I'll try and break it down a bit. What we do is we assist financial institutions maximize recoveries on their unsecured NPLs in an ethical manner. We are headquartered in Singapore. We have operating offices in Vietnam, Indonesia, India, and we are just starting out expanding into the Philippines. We have two offerings, the first one being Flow Outsourcing, where we work with these same aforementioned financial institution lenders on a success fee model, so like a collection agency. The second vertical is Flow Trading, wherein we assist these same financial institution lenders by cleaning up their balance sheet, by buying these NPL portfolios off their balance sheets, thereby enabling them to focus on what they should be doing best, which is lending, and let us work on the collections aspect of things. So that's a quick background about me.
Thank you, Arun. Then moving on next to Jaideep.
Thanks, Jeremy, and thanks to the entire Genesis team for having Trusting Social join. My name is Jaideep. I'm the CFO at Trusting Social. Like Arun, I come from the dark side. I was an investment banker for about 20 years. Let's not talk anymore about that. Instead, let's talk about Trusting Social. We are an AI fintech with very deep IP in building machine learning models on large consumer data sets, like telco data or payments data, to create very accurate credit insights on consumers. Today, we are the largest provider of alternative data-based credit scores globally, with over 1 billion consumers scored by us. So if you think about what Arun talked about as Flow being at one end of the spectrum with banks, we start off at the opposite end. We work with banks and finance companies to help them make the profitable loans to underbanked consumers. We work in 4 countries, in India, Indonesia, Philippines, and Vietnam. Now, in these markets, many consumers, actually, if you exclude the top 15, 20% of consumers, the entire market doesn't have access to financing from regulated lenders. They end up going to local money lenders or going to friends and family. What we do is provide a broad suite of solutions that enables lenders to find these consumers, analyze the risk, and provide them the right loan product, all on a seamless digital journey. So we try to minimize paper, minimize touch points, and make it extremely efficient. We run our business in two parts. One is a pure enterprise business where lenders can come and buy these capabilities on a pay-per-use basis. And the other is a partnership business where we build portfolios in partnership with lenders and take on a portion of the risk and the returns on the portfolio.
Okay. So, but last but not least, right, we have the youngest of the three fintechs here. So T, as I like to call him, would like him to introduce himself and the buy now pay later fintech that he has started.
Awesome. Thank you, Jeremy. Thanks to the Genesis team. This is awesome to see everyone here. My name is T. I am the CEO of a company called Pace. I've been quite lucky. I didn't come from the bank, so I don't know what the dark side is, but I love to go to the dark side one day and see what that is, try to clean it up. That's why I started a fintech, I suspect. But I've been quite lucky. This is my fourth company. My first company was in Silicon Valley that was acquired by Yahoo. Second company was a travel company that was acquired by Expedia. My last company was a real estate tech company that was acquired by WeWork. So this is my first foray to fintech. I have no idea what fintech is all about, but I figure everybody jumps into it. It must be kind of cool. Kidding aside, I have been looking at fintech for quite a bit. It's just trying to find the right entry point to it. It is something that I've been monitoring quite a bit. I always told many people, right? I've started many companies, and one thing that I've figured I've sort of learned is sequence. And I believe that BNPL is a great sequence for me to be able to start a company that ultimately focuses on developing a digital financing platform, right? That allows us to target both on the consumer side all the way down to the business side. So it's a much bigger ambition that we had as a company and as a founding team of the company. But we believe that BNPL is a great starting point for us to be able to tap into the market that we want to get to one of these days. Cool.
Thank you, T. So just as a quick house rules and reminder, for any one of you who's attending this particular breakout room, if you have any questions, please scan the QR code here. The password is up there as well. You can post your question to the pigeonhole, and I'll try and get them answered, right? So I'm hoping that the bulk of the questions will come from you guys. I haven't done a lot of prep work. I'm really overwhelmed by the earlier panel session and the opening remarks. I'm overstressed, and so I'm now just trying to relax myself. So let's dive in, right? So we talk about accessibility, we talk about discrimination. These are the key themes, right, in the formal financial system since its inception. But recent progression in technology have allowed fintechs, right, to emerge as a way to break out these barriers and positively impact the world through financial inclusion. So the World Bank actually defines financial inclusion as having access to useful and affordable financial services that makes the day-to-day lives of individuals and businesses easier. Having a bank account, for example, is considered to be the first step towards financial inclusion because transaction accounts allow people to store, send, and receive payments. I mean, most of us live in the developed world. Some of us will come from developing countries as well. We don't know how lucky we are to be able to get access to financial services, with the blink of an eye. But if we look at the statistics, about 1.7 billion adults worldwide are unbanked or do not have access to a bank account. Many unbanked people live in developing countries, which have a lack of infrastructure and government regulation. And that's why the opportunity is large for the fintechs, right, to go after as well. So maybe the first question, let's ask Jaideep, right? How does digital credit models help promote financial inclusions? And what do you expect Trusting Social to play a part in, right, in the markets that you serve?
Sure. So to our mind, there are three primary benefits that digital credit products and digital models enable. The first, you talked about it yourself, Jeremy, access. For underbanked consumers in our countries, having access to the right loan product itself is a significant benefit. So for instance, this year, almost 15 million consumers will get access to financing from regulated lenders who use our capabilities. Typically, these tend to be $1,000, $2,000 loans around 2-year tenor. So this is a real impact from a financial inclusion standpoint. The second benefit is in reducing the cost of operations. So digital lending reduces the friction that you see in traditional lending. Think about when we go to a bank to get a loan, there's a lot of paper that is filled. Digital lending removes the need for paper documentation. Or the lender needs to send someone to the potential borrower's house to verify they actually live there. We can again do that digitally. So what digital lending enables is a smoother, faster process with less drop-offs for consumers who find it more challenging to go through the hoops of traditional financial services. Finally, lenders, we've always thought about, underbanked consumers as a homogeneous group, which is not really the case. So our score is able to separate the population into risk buckets so that lenders can fine-tune their products, the amount, the tenor, the pricing. And the consequence is that the borrower gets the product that is most appropriate for them at the right price. In Vietnam, for instance, we estimate for new to credit population, so the population just outside of current banking, that previously would have gone to unlicensed money lenders and borrowed at maybe 50 to 200% annualized interest rates. Today, they can go to finance companies and their cost has come down to 25 to 40%. So there's a substantial difference just because there is information out there. So in effect, it takes out inefficiencies, fills in the knowledge gaps that lenders have about these consumers, allows them to create profitable portfolios while reducing cost to the end consumer.
Right. So if I ask you to do a quick summary, right, of what your business model is and how technology play a part, right, in helping these consumers in places like Vietnam and Indonesia get access to banks, financial services, how would you put it, right?
It's making a previously opaque customer visible to banks. A customer who is not part of a credit bureau today in any country means that the bank has no information on them. By creating a technology-driven credit score, we are giving a tool to lenders to analyze that consumer quickly, efficiently, and at far lower cost than before.
Great. And what are some of the markets that you serve?
So we serve India, Indonesia, Vietnam, and the Philippines.
And how big are these markets for you, right? Because for example, Indonesia has about 200 plus million population. What is that size of unbanked versus banked customer, for example?
Across these markets, typically the top 15 to 25% of the country has access to a broad range of financial services, whether it be loans, whether it be insurance, and so on. The rest of the country is underbanked or unbanked. We focus on the middle of the pie, which is the underbanked segment, not really the unbanked bottom 20%. So across these countries, between 60 to 70% of the country is where we play.
Perfect. And just another round of reminder to the attendees of this breakout room. If you have any burning questions for any of these tech leaders, just feel free to either put it in the chat, the Zoom chat, or use the Pigeonhole QR code there. So switching gear a little bit, let's move our attention to T, right? The buy now, pay later concept isn't completely new. In fact, if you're old enough or you have been on the dark side before, you definitely have seen, kind of innings of different types of installment plans financing, right? But combining the idea with the mobile app, and an option at payout has certainly connected with shoppers that, in the UK, Australia, US, and now in Southeast Asia as well. So more than a third of shoppers in these countries, right, are using buy now, pay later. Half of them are at least Gen Z or the millennial generation. So exactly what is buy now, pay later, and why is it so popular?
All right, cool. And you're right, Jeremy. I may not be on the dark side, but I think I'm old enough to be a customer of what the dark side provides. And what I think Jeremy meant is this product called installment purchase plans, which a lot of banks and credit card issuers actually do offer. So if you make a payment using a credit card, you can actually split your payments over 6 months, 12 months, or however long it is, but you pay a certain fee typically, and that's how the dark side makes quite a bit of money. The BNPL section, I mean, the BNPL solution itself sort of takes that component out of the bank facility itself. So think of it to be bank agnostic and card agnostic, right? It can support basically debit cards as well and other forms of payments eventually, all the way down to e-wallets when we choose to make that happen. But the whole idea is then companies like us, Pace, then basically undertakes that risk, offer that split payment solution in the form of the terms. In our case, it's 60 days, 3 payments across 60 days. And we make money by essentially partnering with merchants, businesses, that pays us a form of transaction fees in the form of MDRs, right, which is what the credit card companies makes money from. So ultimately, what BNPL is, if you can think about it, right, what Jeremy is saying is correct. A large sweet spot of our consumer base are Gen Zs and millennials. And millennials and Gen Zs are not the biggest fan of credit cards, right? In fact, if you look at all the reports out there around the world, not just within Asia, credit card adoption has come down because Gen Zs and millennials just do not trust many things, including credit cards. They feel like there's a lot of hidden fees and different things like that. And Gen Zs and millennials are the biggest adopters to e-wallets and alternative payments. So BNPL, in a way, is sort of the credit facility, right, to alternative payments like e-wallets. And we are definitely seeing that as a natural progression for a lot of this the segment that we're going after. But like everything else, it comes with pros and cons, right? BNPL, even though it's been around for a few years, it is not a regulated solution, right, just yet by many countries around the world. Some are more heated than others, but in Singapore, it's been looked at as something that MAS is going to be quite careful about. But look, I think like anything new, especially technology, it is meant to be cheaper, better, faster. But at least for us, as Pace as a company, we want to make sure that we do things in a very responsible manner as well. Just like Trusting Social, we do a lot of our own checks when it comes down to validating our users before they can create a Pace account. We look into their credit scores. We are integrated to MyInfo for those in Singapore. We can extract quite a bit of information in terms of that particular consumer. And then from there, we award them the right buying limit, right? I think as long as we document things in a very clear manner and making sure that we don't give people access to credit where they are not supposed to, I think that makes us to be at least not just a great solution, but a very responsible one as well. So with risk, there's always risk when it comes down to technology. We have experienced a few syndicated fraud events, right? That people take advantage of you. But there's like everything else, you find ways to fill in the holes and the gaps. And at least right now, we've been quite happy with the fact that we're live in 4 markets in just 3 months into the business. We're now officially 6 months, but 3 months in, we actually launched in Malaysia, Singapore, Thailand, and Hong Kong. We have a few more countries to launch in the next couple of months. And now we're serving one of the biggest brands all across this part of the world. And it's been quite good so far. Nothing to complain.
Very nice. Very nice. Thanks, T. So from, giving a unidentified or someone that doesn't have a credit, score in their respective country, that's Trusting Social, to T, right, and Pace, who is actually providing, new generations of consumers the ability and also alternative channels, right, of doing payments. Maybe now we switch gear a little bit to talk about the debt collection part, right? So global debt levels peaked in 2019. The world is awash in debt, right? With trillions of dollars owed to credit cards, mortgages, loans, and installments and credit purchases as well. A lot of this is actually expected to be paid late or even defaulted on in the next few years. And yet, there's a lot of billions of dollars being invested into financial startups, but very little money actually going into debt collection companies, according to Crunchbase in 2019. So finally, over to Flo, right, and to Arun. Debt collection typically operates under the radar. And in Southeast Asia in particular, I think we are quite used to hearing about the abrasive and abusive methods of debt collectors using to enhance their collectability. So how does Flow does it differently? You mentioned AI enable, right? How do you inject technology into debt collection? Over to you.
Thanks, Jeremy. You know, it's funny, the second you hear the word collections, the brain immediately goes to like large thugs with tattoos carrying baseball bats, breaking people's knees, carrying like red paint, smearing it on people's houses, all to try and force the borrower, who's sadly delinquent for whatever reason, to try and pay up money as quickly as possible. And to be honest, your brain would not be wrong if you think like that. And sadly, in all our operating entities, be it Vietnam, Indonesia, India, Philippines, that's exactly the kind of practices that occur in the collection space. What we do is the complete opposite of that, right? So when we receive a portfolio from a financial institution lender in the unsecured space, that's the only segment that we work in on the collection side. Whenever we receive any portfolio, we slice and dice it up into various homogeneous groups. Each homogeneous group is targeted using a certain proprietary strategy. That strategy consists of three parts. So our first AI module, when you were asking about how we implement artificial intelligence in our collection process, the first module that we have is how do we go about slicing and dicing these portfolios, right? It's say a bank XYZ gives us 50,000 delinquent credit card cases. How do we go about envisioning slicing it up into various parts to try and target each homogeneous segment? Once we've done that, we try and figure out a three-step process of going about doing collections. First and foremost, which is extremely important, is education. And the reason education is so important is because of the advent of companies like Pace, the number of fintech companies out there, credit is a very new thing to many of these borrowers. A very sleek UX UI, 3 clicks, suddenly $100 shows up in your account. And then you have to pay, say, $110 or $120 at the end of 6 months. How does that work? Like, what does that mean? How do I have to pay it back? There are all these questions that borrowers genuinely do not understand. So the first process is education of the borrower. Then comes our proprietary collection strategies, where we entail the use of SMSs, WhatsApp, Zalo, Viber, whatever other social media communication channel, emails, automated phone calls, as well as operator-led calls. You would notice I did not mention baseball bats or paint cans because we do not have a single field collector who goes to people's houses trying to threaten people. Instead, every single aspect of our collections is done using soft means of trying to connect with the borrower through educating, and then through these various modes of social media and through various channels of communication to explain to them why it makes sense for them to pay back their $100 or $500 loan so that they can take like a $2,000 or $5,000 loan in the future. Like, how do you get back into the financial ecosystem rather than be castigated out by them? Third step, but not the least, is another artificial intelligence module that we pride ourselves in is the quality control aspect. So all the SMSs, emails, WhatsApps, automated phone calls, all the wordings, all the strategies that have been created using that can be controlled at the center quite easily. But at the end of the day, we also have operators who talk to the borrowers. So even though we've created a smart script that enables the operators to use certain psychological arguments that we believe will maximize recoveries, there is still this uncertainty of what the operator will actually end up saying to the borrower and or vice versa. So we have a QC model where we convert all the voice recordings into text, run that text through a whole bunch of filters to ensure no under-the-table dealings are taking place, no bad words are being used. Is the emotion of either the borrower or the operator getting elevated to a certain level where we should cut that call and immediately pass that over to a supervisor? So those are the various aspects that we try and use artificial intelligence to bring it into this very traditional space of collections. And a big thank you to Dr. Felix, who's attending this call. One of these big quality control modules were actually funded by DEG.
Interesting. So I think I saw T getting a bit ready to get a few comments on things like credit is readily available. Does buy now pay later actually encourage irresponsible spending, right? So maybe T, if you want to address that.
Yeah, I mean, we briefly talk about that just now. I mean, in many ways, if different companies and different ways of doing things. At least for Pace, we want to make sure that we do it in a very responsible manner. Financial inclusion is a big part of what we're trying to achieve as well, because the thing about BNPL is it's a form of lending, but it's also not a form of lending where you are giving somebody cash, right, upfront to go in and spend. It's allowing you to spend and buy and purchase services and products from a network of a community of merchants that you've sort of signed up. So it's a more controlled environment in that sense. But like everything else, I mean, there's always chances of people, that do not understand this and not really know exactly what it's all about. And like what Arun said, education is a very important part of it. We have a blog site, we have a podcast, we do whatever it takes to really educate our consumers in terms of what BNPL is all about. If you ever download our app as well, the very first thing that you see is your buying limit, right? A lot of our competitors out there don't really show the buying limit of what you can or cannot purchase. And to me, that's in a way kind of unethical. And you're sort of not telling your consumer exactly what you can buy with your BNPL account. But for us, I think we want to make sure that we do it the right way, and we do it in a way where at least we can be proud of the company that we're trying to build.
And coming back to the theme of this breakout room, right? Do you consider buy now pay later as enabling financial inclusion?
I believe so, right? Because I think from a lot of the cases that we've seen, we have had merchants that provides sort of day-to-day type of products and services that people do need, right? When we first came to this, we thought that a lot of folks are going to be using this to buy high-valued items, right? There are cases where people are using BNPL to split their payments to make things a lot more affordable for higher value items. But we are seeing people spend on $50 to $100 worth of products or services just because this is a way for them to be able to manage their cash flow better and afford them. And we've been quite lucky. We've seen that at least our debt hasn't been significant. In fact, it's below sort of norm average for a country like Singapore, for example, as a comparison. And we've seen that people are generally grateful, right, for this product to be available, for them to be able to spend when they need to spend, and be able to spread their purchases over time and manage their cash flow better.
So I guess you don't really need flow services for time being.
No, there are cases where, like I said just now, that there is always a syndicate out there, that leverages and plays to their advantage, and we have been hit by syndicate, right? But that taught us a few lessons in terms of what we can or cannot do. But Arun, I'm sure we'll be talking soon, in terms of leveraging your services to help us out. We too don't believe in sending people with tattoos and for some fraudsters, we do believe in that, to be honest, but we cannot really execute that, right? It's just between all of us here, many of us here. But yeah, I mean, we want to make sure that we do the right thing.
Thank you, V. So there are two more questions, one for Jaideep and one from Arun. This came from the Pigeonhole site. So for Jaideep, can you elaborate on the main differences you see in the different countries that you operate with regards to the services that you offer? What are some of the challenges and demand, right, in Vietnam versus Indonesia, for example?
Sure. So let me leave COVID aside for a minute, because clearly how COVID has played in each of these countries has been very different. What we realize is that the biggest determinant of adoption is how much time we spend in a market. So because we've been in Vietnam for more than 4 years, we are well integrated, we have a larger number of clients who use us much more extensively. The second determinant is how strong the local credit bureaus are. So for instance, in India, because there are 4 credit bureaus, they've educated lenders on how to build scores, how to build scorecards, combine it with application data. Therefore, when we go with a new score out there, a new way of looking at consumers, every lender's first reaction is, great, let me test it. So the willingness to test, learn, and improve, and then adopt is much higher in countries where lenders already are working with established credit bureaus.
Hmm.
Whereas if you look at other countries like Indonesia and so on, there's a lot more education that needs to happen, right? So there's a different time. The other products we have, again, because we are first in Vietnam, so apart from our credit insights, we rolled out our fraud scores first in Vietnam. We are rolling out our income score first in Vietnam. But location verification, surprisingly, which is establishing the location of a particular borrower at the point when they apply, is more popular in India and Indonesia, because for a lender to send someone to a person's house to verify the address is much more difficult in those countries. So a digital solution is much better. So broadly, we find human dynamics are similar. So models are very portable. The starting model is very similar in each country. But the use cases, the kinds of loans being done, and the kinds of lenders who want to expand the market are completely different. By and large, we find VC-backed finance companies to be the most aggressive in expanding the market. So they're the ones who will get talent from across the globe, bring them in, build proper systems for delivering and doing loans. And then once they're successful, others quickly adopt and grow from there.
Okay, so I think we have a bit of time running out here. So I just want to get a question to Arun from Pigeonhole. How effective is the soft means of method compared to the traditional baseball bat? As some people really don't have the means to repay, right, when they start defaulting.
So that's an excellent question. And that's something that a lot of lenders, especially the more traditional kind, like the larger banks and MFIs, I would say, they ask us this all the time, right? Because they already have established channels with these traditional collection agencies. We don't see each other as competition, or at least we don't look at traditional collection agencies as competition. And that's because our way of collections is completely different, right? The value proposition we bring to a financial lender is that your reputation will never be sullied. In this day and age of social media, it's so easy for a borrower who's not been treated well by their financial institution lending counterpart to go onto social media and start complaining that, look, this is COVID. I'm obviously personally affected because I don't have a job. I can't believe that XYZ bank is treating me like this. And we've seen the repercussions of this, right? Where 35 fintech companies in India got yanked their licenses to lend because they went about, not because of their lending practice, but because of their collections practice. So we believe that as time goes by, that risk of the reputational risk for a financial institution lender is going to be a lot more than just trying to collect a certain amount of extra money by threatening someone. The other aspect that we bring to collections is scalability. So a traditional mom and pop shop, right, that employs 20 thugs, they can do fantastically well for collections, potentially, in a certain village or in a certain district. When it comes to start being more of a digital lender, where you're not sitting and lending through a merchant shop in a certain small locality, you need to have collections that are also digital. The aspect of trying to go about identifying and contacting a lot more delinquent borrowers than these 20 thugs running around in a certain village is something that we can achieve using our digital skip tracing capabilities a lot higher. So we can reach out to a lot more people than field collection agencies. We can reach out to these same borrowers through multiple means of communication, multiple times in a day, as compared to a thug going to borrower A, threatening the person, beating him up, collecting some amount of money, then going to the next person, probably meeting, say, 10, 15 people a day, going through the list of 100 people, and then circling back to the first borrower. We, on the other hand, have this omni-channel approach of collections where we can reach out to these people. We identify them using digital skip tracing means a lot more effectively. Thereby, on average, our collections would be a lot more for a certain portfolio. So if it's one borrower that is delinquent, by 10,000 US dollars or something, vis-a-vis our approach, we will not be as good as a field collector. But we don't play in that space, right? We play in the space of consumer unsecured or retail or SME unsecured debt, where you're dealing with very large volumes of delinquent portfolios.
Well, okay, after this, I better make sure that I get my credit card bills fully paid before I get into trouble as well. So one last question, and to wrap it up, right? And we'll go down the line. Do you guys think that fintech will dominate the world, or will fintechs coexist with the traditional financial institutions, right? So let's start with T first.
I don't think it will take over the world, but I think it will coexist. I think it will just make things go faster, cheaper, better. It will speed up things. It will open up the minds and ideas, and sometimes maybe fight, right? In terms of going from traditional to something better. So I do believe in that.
Thank you, T. Next to Jaideep.
I think he's absolutely spot on. It's a question of coexisting. Banks will need to get more innovative. They'll become smarter. They'll learn from the fintechs. Fintechs will create, open up new markets. But there is overall, both will coexist. There's space for both of them as we look forward.
So I like your comment, because when you say that you've been on the dark side and banking is on the dark side, right? It's because I think maybe because someone didn't turn on the light, right? And that's why they didn't know where the innovation is heading. And last but not least, Arun, please.
That was a bad joke, Jeremy. I like that.
I planted one, so and Jaideep gave me that bullet to do it. So over to you, Arun.
From our perspective, either or, whichever way it works, it's completely fine, because the more lending, the better for us, because at the end of the day, regardless of anything, there'll always be NPLs, and that'll benefit us. So from our perspective, either or.
The more fintechs there is, the better business for you, right?
Exactly.
Great. Well, thank you all, everyone, for joining us. Thanks to T, thanks to Jaideep, thanks to Arun for spending time with Genesis and at the Genesis Forum. We hope you guys have enjoyed the last few hours. Hopefully we'll see you guys at Genesis Forum 2022 in person. All right?
See you.
Thanks, Jeremy. Thanks, everyone.
Stay safe.